If you're an income-focused investor in 2025, chances are you've come across a whole new breed of ETFs products that promise eye-popping yields, regular monthly payouts, and sophisticated option strategies baked right into the structure. These aren't your grandparents' dividend funds. In fact, they're not even your older siblings' blue-chip ETF. We're talking about a fresh wave of innovative funds designed to extract income from volatility, sometimes even more than from the underlying stock's dividends. And names like MSTY, YieldMax, NVDY, PLTI, and XYLD are leading the charge. In today's video, we're going to dissect this high-octane corner of the ETF world. We'll break down how these ETFs work, why they've exploded in popularity, the potential risks they pose, and most importantly, who they're actually for. The new era of high-yield ETFs. In the past, income investing meant buying companies like Coca-Cola or Johnson & Johnson, collecting 2%, 4% annually, and reinvesting dividends for slow, steady compounding. But that playbook has evolved radically. In today's macro environment, interest rates have fluctuated dramatically and traditional bond yields don't always outpace inflation. Meanwhile, growth stocks, especially in tech, have surged in value but often pay zero dividends. Enter the high-yield option income ETF. These ETFs are designed to manufacture yield by selling options, mainly covered calls, on stocks or indexes. This allows fund managers to extract premium income from the market's volatility and redistribute it to shareholders as monthly cash flow. Some even use synthetic positions or concentrated exposure to amplify returns. With monthly yields ranging from 10% to 30%, it's no wonder income-focused investors are piling in. But be warned. Higher yields often mean higher risks, and these products are not set-it-and-forget-it investments. MSTY, the MicroStrategy Covered Call Fund. Let's start with one of the most talked about, MSTY. This ETF writes call options on a single, highly volatile stock, MicroStrategy, MSTR, a company many view as a leveraged proxy for Bitcoin. Why MicroStrategy? Because it's one of the most volatile large-cap stocks in the market, and that means high implied volatility, which translates to larger options premiums. MSTY capitalizes on this by selling those juicy premiums and distributing them as monthly income to investors. In late 2023, MSTY was paying out $3, $4 per share each month, an astronomical figure compared to traditional ETFs. However, that income drops dramatically when volatility falls or MSTR's price stagnates. In fact, by mid-2025, MSTY's yield has trended down to around $1.20, $1.50 a month. So what's the trade-off? If MSTR explodes upward, your upside is capped. If MSTR tanks, you still take the hit. If MSTR trades sideways with high volatility, that's the sweet spot. MSTY is not for the risk-averse. But for investors who believe in Bitcoin's volatility and want to harvest yield from it, MSTY is a bold strategic choice. YieldMax's Tesla income machine. Next, let's shift to one of the flagship YieldMax ETFs, YieldMax, which focuses solely on Tesla, TSLA. Tesla is already a magnet for traders due to its erratic price swings. YieldMax taps into that volatility by selling covered calls and turning that movement into income. This strategy generates powerful monthly payouts, often well over 1% per month. But it's also incredibly sensitive to price direction. When TSLA rockets, you miss the upside. When it crashes, you absorb the downside. YieldMax is best suited for tactical investors looking for short-term yield, Tesla bulls who think TSLA will remain range-bound, income seekers who don't mind volatility. Just remember, this isn't a long-term buy-and-forget holding. This is a use-it-when-it-makes-sense ETF. NVDY, the NVIDIA-centric yield play. Let's talk about NVDY, YieldMax's answer to NVIDIA. NVIDIA is the poster child for the AI revolution. It's fast-growing, high multiple, and, until recently, offered no dividend. That's where NVDY shines. By selling covered calls on NVIDIA, it extracts option premiums and turns them into monthly yield. In some months, NVDY has distributed up to 3% of NAVI, rivaling even REITs and MLPs. Of course, the same trade-offs apply: capped upside if NVIDIA runs hot, exposure to downside risk, dependence on volatility to sustain yield. For NVIDIA fans who are okay missing some capital appreciation in exchange for income, NVDY is a creative solution. If MSTY, YieldMax, and NVDY are surgical, single-stock plays, ULTI and PLTI represent a broader, diversified strategy with synthetic overlays. ULTI uses options layering across several growth stocks, think Amazon, Microsoft, Meta, and combines short-dated call selling with tactical positioning. This boosts income potential and smooths out single-stock risk. PLTY, meanwhile, offers a more diversified basket of tech stocks and aims for a steadier yet still impressive 1–2% monthly income. Both funds are newer entrants but gaining steam. Investors love that they're tech-heavy, yield-rich, less vulnerable to a single stock's meltdown. They suit income seekers who want more balance and less dependence on just one ticker. Let's not forget the old guard, XYLD, the Global XS&P 500 Covered Call ETF. Unlike the newer, edgier funds, XYLD plays it conservative by writing monthly calls on the entire S&P 500. That means greater diversification, smoother returns, more predictable income. XYLD typically yields between 8% and 10% annually, less than the flashy YieldMax names, but with far lower volatility. It's ideal for retirees, conservative investors, or anyone seeking stability with income. Here's the burning question. Can these ETFs continue paying these massive distributions? The answer? Only if volatility remains elevated. These ETFs don't generate yield from company profits or dividends. They manufacture income by harvesting volatility through option premiums. If implied volatility declines, the option premiums shrink, and the monthly payouts follow. So while the income may look tempting today, it's not guaranteed forever. Also consider that capital appreciation is often sacrificed in these strategies. In strong bull markets, these ETFs will underperform traditional equity funds. You're capping your gains to boost your cash flow. Most high-yield ETFs distribute non-qualified income. That means the IRS treats it as ordinary income, taxed at your marginal rate. If you're in a high tax bracket, this can bite. That's why it's often best to hold these ETFs inside tax-advantaged accounts like Roth IRA, traditional IRA, 401k, HSA, if applicable. Tax efficiency matters more than ever when you're generating income every single month. These ETFs aren't for everyone, but they are ideal for certain investor profiles. You might consider them if you need regular monthly income, are okay with volatility and drawdowns, understand the trade-off of capped upside, use them as tactical allocations, not core holdings. Some investors use them for short-term income boosts during retirement. Others treat them like dividend steroids in a diversified income portfolio. In 2025, high-yield ETFs are more sophisticated, more targeted, and more popular than ever. From MSTY's Bitcoin-adjacent payouts to YieldMax's layered tech income strategy, the options are growing fast. But remember, high income doesn't come free. These ETFs carry real risk. Volatility can work for you or against you. Upside is often sacrificed, and sustainability depends on ever-changing market dynamics. So if you're chasing yield, make sure you're doing it with your eyes wide open. Understand the risks, know the strategy, and use these tools smartly within a broader, diversified portfolio. Because in the world of high yield, the income is real, but so is the volatility.